Hello class. In this video I want to talk about some long-term liabilities. Specifically I want to talk about financing options and earnings per share. Now there are two basic types of fundings available for businesses to finance themselves. You have equity financing and debt financing. Equity financing is when a corporation issues common or preferred stock, or if it's a non-corporate entity, the owners invest their own personal assets or personal cash into the business. Debt financing, on the other hand, is where a business borrows money from a bank or some lender, or they issue bonds. Okay. The same way, if you think about purchasing a car, you can either finance it with your own money, which would be equity financing, or you can go ahead and borrow the money and take on debt. So you would sign a note and you would have a liability on your books until you pay it off. And so that would be an example of debt financing. There's different considerations when you're thinking about financing with debt versus equity. You want to think about how it affects this one measurement of profitability called earnings per share. You also want to think about whether or not you're able to make the periodic interest payments that are due with debt. Interest payments are deductible for tax purposes, and therefore it would lower your tax liability. Failure to pay your debts back can force you into bankruptcy. And when thinking about equity financing, corporations are not required to pay dividends. And over here on this slide, again, you have just some more reasons and advantages and disadvantages for financing through equity and as well as financing through debt. Now, earnings per share is a measurement of profitability. It serves as an indicator of a company's profitability on a per share basis. Earnings per share is a portion of the company's profit allocated to each outstanding share of common stock. It's generally considered to be a single most important variable in determining a share's price. So when investors look at purchasing or investing in a company, they look at earnings per share. Going back to what I was saying earlier about earnings per share as a portion of the company's profits allocated to each outstanding shares, what I mean by that is if you take a look at a company, and let's say they have 100 shares of common stock, and for the year they had net income of $100. When you take $100 of net income and divide it by 100 shares, the earnings per share would be $1 per share. Now let's say the next year, the company's income increases to $150 and there's still 100 shares of common stock outstanding. In the second year, when you take $150 and divide it by 100 shares, the earnings per share has now increased to $1.50 per share. Now here's an example of an income statement. In class we've seen many income statements, and this one's slightly different in that you see a few of the line items, one especially after operating expenses, and it's called earnings before interest, expense, and income taxes. And that's basically equivalent or almost equivalent to operating income, which I've mentioned in class several times. Now in order to arrive at net income from earnings before interest and income taxes, you have to subtract two more things. You have to subtract interest expense and income tax expense to arrive at net income. And net income is one of the variables to calculate earnings per share. Another variable in calculating earnings per share besides net income is preferred dividends and the number of shares of common stock outstanding. So in this example, if we assume that we have an earnings per share, if we have earnings before interest, expense and income taxes of $1 million, an income tax rate of 30%. We have debt that's owed of $1 million, and we're paying 6% interest annually. We have 20,000 shares of 6% $100 par issued and outstanding stocks. And keep in mind that 6% represents the dividend on the preferred stock. Remember, 6% of $100 is a $6 dividend for every share of preferred stock. And we have common stock. We have 50,000 shares issued and outstanding. We would need all this information to calculate earnings per share. So going back to the income statement, we start off with earnings before interest, expense, and income taxes. And you would need to calculate the interest expense and then the income tax expense. Okay. And to calculate the interest expense, you take the amount borrowed times the interest rate, and that gives you $60,000. You subtract that from earnings before interest expense and income taxes, and that gives you $940,000, and that's called income before income taxes. Next, you multiply your income tax rate of 30%, multiply it by $940,000, and you have an income tax expense of $282,000. You subtract that from the number above, and that gives you net income of $658,000. Again, you need to know your net income to calculate your earnings per share. The next thing we need to know is how much preferred dividends have to be paid out of net income to go to preferred shareholders. And in this case, since we have 20,000 shares, and I said that the dividend is $6 per share of preferred stock, 20,000 times 6 gives us $120,000 of preferred dividends. We're going to subtract that from net income, which leaves earnings available for common shares of $538,000. When you take that amount and divide it by the number of shares of common stock, which is $50,000, you will arrive at $10.76 per share, and that's known as your earnings per share. I provided another example for you guys to take a look at and practice. On this next slide is a solution. So in this video, we talked about earnings per share and the different advantages of debt financing and equity financing. In the next video, I'll be talking about present value of a dollar and bonds.